All right, and we're back, and we're in Chapter 7, the financial management chapter of Liberate, Your Journey to Lasting Financial Independence. We're going to be picking it up right here, talking about assets versus debts. This is so important to remember throughout your life. Relatively simple, but so important. Okay, for our 5 purposes and simplicity, an asset is something that increases your cash, while a debt is something that depletes your cash. For example, your house might require a mortgage payments, decreasing your cash each month. So it's considered a debt or liability. Conversely, a rental property that brings in more money than it costs each month is an asset because it increases the cash in your bank account. Right? So we just have this little picture here, right? And it says assets equals your cash going up, right? More money's going into your pocket. Debt, cash is going down, money's coming out of your pocket. Okay. And no, your house is still not an asset after you pay off the mortgage. Why? Because it doesn't increase your cash position every month. Your house will still always decrease your cash in the form of property taxes, HOA fees, utilities, and maintenance costs. So your house will always be considered a debt for FI purposes. If it doesn't increase your cash, it's not an asset. That doesn't mean an asset needs to provide you with money every month. You may own stocks for a long time that pay no dividends, or a piece of land you're holding on to for commercial development that generates no current income. But that doesn't mean they're not assets. At some point in the future, you anticipate selling them both for a lot more cash than you paid for them. So they'll increase your cash at the time of sale and are considered assets. Remember, an asset improves your cash position. Assets tend to increase in value over time, while debts typically don't. Or worse, debts depreciate in value over time. That means they are worth less than when you originally purchased them. To be financially intelligent, you must determine the difference between assets and debts. The wealthy decision is to focus all of your financial time and resources on accumulating assets, not debts. All right, common types of assets include stocks, which can appreciate in value and pay dividend income. Real estate, such as multifamily, commercial, or industrial properties, which appreciate in value and generate income through rents. And bonds, including notes, where you act as the lender, which generates interest income. Intellectual property, such as books, music, scripts, or patented inventions, is also an asset, as it can pay royalties. Remember, all assets are eventually worth more than you paid for them, or produce an income stream, or both. Okay. It's also advantageous to accumulate assets that don't produce taxable income as they grow over those that do, because paying taxes annually reduces growth. Examples of assets that don't create taxable income as they grow include privately held businesses, appreciating real estate, publicly traded equities without dividends, retirement accounts, and annuities. All right, the asset versus debt continuum. Over the years, your personal FI journey will be prone to having many emotional ups and downs, like a mountain range. Now picture that mountain range as a jagged line on a piece of paper. This line represents the highs and lows of your FI journey, right? So here's that jagged line, and as going through time, you're going up and down and so forth. Okay, so now imagine stretching that jagged mountain range into a straight line. So you're taking this line right here and you're stretching it out into this continuum, this straight line right here. Think of it as a tool to gauge where you are at in your FI journey. In the middle of the line is the 0 point, which represents no debts and no assets. Remember, in the beginning of the book, we talked about starters, winners, and so forth. We're kind of basically providing a mental picture of that right now. Okay, it's going to help you gauge where you are in your financial journey. In the middle of the line is the 0 point, which represents which represents no debts and no assets. So right here in the middle. The left end of the line represents infinite debt, right over here. And the right represents infinite assets over here. Your phi number is represented somewhere on the asset side of the continuum. So remember, you're going to set a goal, right? You have somewhere you want to get, the destination, and it's going to be somewhere on this asset side. Because everyone's situation is different, everyone will start at a different point on the asset versus debt continuum. And because everyone's financial number is unique, that too will be a different point on the asset line between 0 and infinite assets. So we're basically saying, okay, here we are, here's our goal, and then we are somewhere, right, between somewhere on this continuum. This is just an example. Let's say we're here where we have some assets, but we haven't met our goal. Some of us, right, we're going to be fixers. We're going to be over here. We're going to have too many debts, and then we're going to have to get over onto the asset side of the continuum eventually to become financially independent. The important concept to recognize is that no matter where a person is currently on the asset versus debt continuum line, each financial decision moves them to the right or left, right? So each decision you make, like say this is where you are now, each decision you make is either going to get you closer to having more assets or closer to having more debts. That means that each financial decision, whether big or small, gets you further into debt or closer to reaching your phi by increasing your assets. Making poor financial decisions is destructive. While you can still make some small poor decisions and still become phi, you must make a lot more wealthy decisions to arrive at phi. Nevertheless, the absolute truth stands that for every poor decision you make, however large or small, it moves your current position to the left, and the time to achieve phi increases. Said another way, for every poor decision you make, you will spend more time in a state of poverty and less time in a state of wealth. Why? Because a dollar you spend on a poor decision is a dollar you could have used on a wealthy decision to decrease your debt or increase your assets, getting you closer to phi. Okay, we're going to go ahead and pause right there and then pick it up with wealthy versus poor choices revisited in the upcoming video.